focus now to the top global story that we are tracking. Last week, Federal Reserve Chair Jerome Powell, in his address, spoke on labor markets in transition. Now, he has signaled a cautious approach to monetary policy, balancing persistent inflation above the 2% target with a softening labor market as unemployment has hit that 4.2% level. Now, with markets eyeing a September rate cut, Powell remained non-committal, emphasizing data challenges and central bank independence amid political pressures. But he's also dropped in some positive hints. Now, let's listen into what he said on the labor market and the effect of tariffs on prices. Let's take a look.
The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. The labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity.
And we also have Varun who's standing by to give us all the roundup of Powell's comments. Let's go across and listen in to what Powell had to say.
Okay, so it was Jerome Powell's, Federal Reserve Chairman's speech, which everyone was eyeing at the Jackson Hole Symposium. And the most important thing at the speech was his tone, which is now more dovish rather than hawkish, which he used to be earlier. And the focus is now being shifted to data rather than inflation. And Powell has said actually that the labor supply has actually softened in line with demand, and the situation suggests that there is a downside risk to the employment, which is actually rising. No doubt he has kept his overall inflation target. He has reaffirmed his inflation target of around 2%, but he has also said that the effects of tariffs on consumer prices are now clearly visible, and also he expects the effects to accumulate in the coming months. Although the reasonable base case is that the inflation effect on tariffs are actually short-lived. But yes, the focus has now been shifted to actually, job market or labor conditions rather than inflation. And, this was his last speech at the Jackson Hole Symposium as the Fed chairman. So, but the market is liking it because if you see, after his speech, the probability of rate cuts have actually increased, and now many are expecting that you would see a 25 basis point rate cut from the Fed in the month of September, and going ahead also you might see more rate cuts by the Fed. Also, this has been liked by the equity markets and also asset classes world over, because if you see, after the federal bank's comment, we have seen rally in the US markets. The Dow Jones was at life high. Also, we have seen rally in other asset classes like Bitcoin, like gold. But yes, we have seen decline in the overall bond prices in the bond yields of US markets, may it be the 10-year yield, may it be the 2-year yield, or may it be the 30-year yield. This decline is basically because people are now expecting that you might see a rate cut in the month of September. So it was the last speech of Jerome Powell as a Fed chairperson at Jackson Hole Symposium, and the equity markets, or majority of the markets, are actually liking it.
All right. Thank you, Varun, for taking us through all those details and the key comments that Fed Chair Jerome Powell made during his Jackson Hole Symposium speech. But